All right. Hello, everybody. Thank you so much for joining us for our fall 2023 Gentian Forum. From wherever you are and whatever time you're watching this, we're going to bring you all sorts of timeless pieces and different things that we can share regarding financial planning and the markets in general. So looking forward to speaking with you all. So we're going to start off today with the Gentian update, let you know what we got going on behind the scenes here, questions that we're specifically hearing from you, and then some financial planning concepts. So looking forward to it.
All right. Thank you, Michael. I appreciate your introduction this wonderful, wonderful day. And to those of you who are listening to things right now, I want to welcome you to the program. This is going to be fun. We're going to have a great one. It'll be a bit abbreviated, even maybe concatenated a touch. I don't know what that means, but I thought I'd bring it up because it sounds very, very nice. We might even bring some things that are interstitial to the program that we normally would have. But most importantly, I would like to begin the day with going big. What are you grateful for? Take out a pen, take out a paper, write it down. What are maybe 3 things in the last 90 days that you're grateful for? All right, I've got a list of about 100, but let me give you 3 off the top of mine. First of all, mine is looking at my daughters. They made massive progress lately. They're a senior and a freshman in high school and really, really enjoy everything that they bring to us. Also, the autumn. Autumn is a wonderful time for me for reflection. It's a time of a lot of, I'm going to call it great memories, football games and all sorts of fun stuff. So really love the fall. And also my mom and inspiration of how she has, in the last 5 or 6 months, made some great strides in her life as well. So those are 3 for myself. How about maybe let's go to Ken. How about yourself?
Thank you, Chris. It's good to be here with you all as usual. And yeah, my go big is for the family and the traditions that are coming up here in the fall, and we're entering into the holiday season, if you will. So just I'm grateful for the traditions, brings us close together as a family and other families as well. And just wanted to say that's what I'm grateful for today.
Awesome, brother. Thank you very much. How about Mike? Mr. Mann.
Thanks, Chris. I'm really grateful for random acts of kindness and passing it along. It wasn't too random, but most recently I participated in a little charity event that Zach actually helped organize, where we worked out with a bunch of individuals who, and some of which were mentally disabled, and got to provide some sort of, it was just an experience all the way around, and to see the smiles on their faces and all those sort of things. Well, anyways, that was amazing to start. I left there with a ton of energy, just feeling really great. On my drive back, and we're coming from pretty much inner city Milwaukee at this point, and there was, we'll call it a makeshift lemonade stand, where there were 2 individuals who had some bottles of water and some different things, and they were at the median kind of by a stoplight selling, water. And pulled up to them, and I gave them $20 and bought that bottle of water just to make their day, and it truly did. And I don't know that would have happened if I wouldn't have started off the day just in such a positive light, and then wanting to pass that forward and carried it on. So I would like to think that whatever they did going forward with that, I hope it made their day and they passed it on to somebody else. So it's random acts of kindness.
Thank you very much, Mike. I appreciate that. That's awesome. How about a random act of gratitude, Zach?
Thank you, Chris. Now that I'm 30, I'm glad I could finally grow some facial hair. Just like the other gentleman in the office. No, I'm teasing. It's like Mike and I talked about it beforehand, but just shows that we're on the same page. As my gratitude goes to collateral good. And we always hear about collateral damage as things that occur in war or an unintended consequence of an action of some kind. But when you're in service of others without expectation of anything in return, every single time without failure, there is a collateral good that occurs, either something you observe in those moments or something that has physically happened to you or comes after. And Mike's example is a perfect example of collateral good, right? You show up for a workout, you support a cause, your mindset changes, a new, pathway in your brain, and you look for a way to pass it forward. It's just incredible, and kind of have seen it nonstop to really start this year. So thank you for sharing that, Mike, and thank you for asking, Chris.
Thank you very much. Well, with that, Thank you for going big, and you can share yours now. We'll wait probably 4 or 5 minutes for you to share your gratitude. I'm joking. Thank you, though, but for sharing yours, gentlemen, that's awesome. Now we want to talk a little bit about the questions that we're hearing from you. A lot of times the question that we're hearing are really about things that to do with the economy, the markets, interest rates. But what's interesting right now is I heard this one just recently, and I think somebody was talking about the economy and said, you know what the worst part about the economy is? That we're in it. And that struck me as, wow, today there's a lot of negative news. There's wars going on. There's things going on in the Gaza Strip. There's, the Hamas, there's Ukraine. There's all sorts of things going on all across the United States and the globe. And it's interesting when you look at that, there's a lot of people quite negative on this. And there's 3 things this reminds me of. One is faith in the future that things will get better. Another one is the patience to get through times like this. And then the discipline not to do anything silly or listen to your neighbor who wants to offer you unsolicited, free, unqualified advice at this point as well. But those seem to be some of the times we're in. What I really want to understand, though, all kidding aside, is we get it. This is a tough time. You're seeing an awful lot of data out there, a lot of statistics. If you're borrowing money, it's really expensive to borrow money. If you're out there essentially putting money in CDs or money market, it might seem appealing. We're going to talk more about those today. But a few things we're going to hear, and we've been hearing from you. Let me go through a few of them. First, we're hearing from you what's happening in the markets. Of course, we'll talk about, as we always do, what's happening with interest rates and inflation. What should I do with my cash reserves? What should I do? Or should I be worried about the current events impacting my portfolio? You can see number 4 there. Number 5, what planning opportunities are there? And then 6, should I be worried about cyber threats? I've been talking about technology and the great sides of technology, and technology is getting better and better every day. So are cyber criminals. So one of our jobs is to keep you protected from both markets, from cyber threats, from all the things we can probably offer in those categories. But that's what we've been hearing from you guys. Let me give a little bit about what's going on behind the scenes. Let me throw that one over to Michael. Oh, there you go.
Thanks, Chris. Hey, I'm actually gonna pass this one right back to you. Peter, could you back it up 2 slides? We got something really special that's happening behind the scenes for us, and I'd like Chris to just take a moment to introduce.
What I wanted to do, we went 2 slides ahead. I'm sorry here. So one thing you'll see about us often is we have a new member from time to time. In this kind of economy too, we're very fortunate. You see, we recently have added Michael Birschbach, and that's from Charles Schwab. Some great companies once in a while will let one of the really good ones get away. It's happened again for us. Like to introduce you, and some of you already met Lauren Frecka. She's great. She comes from Northwest Mutual Life. She was at one of the top agencies there, and she was able to come and join our group, introduced to us by Zach DeBoer. She's been with us for over 90 days, doing a wonderful job, learning a ton here. And you may hear from her as it comes to relationship manager like Lisa, like Julie, and like Angie. So she's joining that team of our client experience, and she's been doing a wonderful job so far. And we just want to make sure that when you see her, you welcome her. And she's our newest and youngest member of the team, which is outstanding, with almost 5 years experience in the business, which is great. So thank you, Mike. I appreciate that.
Absolutely, Chris. Absolutely. Got to give Lauren her credit. She's really has come on and done a wonderful job for us, and I appreciate everything that she's done and brought to the table. So her perspective is completely it's irreplaceable, and that's wonderful to have. So to start off, we're going to talk about, and with some of the things that we're doing behind the scenes, and this is pretty much all the time. This slide has been able to remain unchanged for a lot of variety of different reasons, because what we do is timeless. It's sticking to the plan. It's sticking to the way that we are going to continue to best utilize your hard-earned dollars. So at the end of the day, we talk about portfolio holdings. We review those on a quarterly, annual, weekly basis even. So at different variations and as needed, that's something that we're continuing to do. We're continuing to review planning items, and that's through different practices of continuing education, which we'll get to a little bit later, or just trying to navigate the ever-changing planning landscape. So as those things come up, we'll bring them to you either in means like this or through our individual planning meetings. So continue to look at cash alternatives. There's cash is worth something again, so that's something to consider. Reading for perspective. We always try to, again, get better in the way that we serve you. And reading provides us some of these different things that is unspoken. Really. We evaluate ways to improve our deliverables. What this basically means is that we're looking at new technology. We're trying to innovate. We're trying to find different ways that we can become better, more efficient, so that truly we can serve you the best that we can. Meeting with industry experts, recently had the portfolio manager for one of our recommended mutual funds in the office, and those conversations are irreplaceable. I mean, truly, the perspective that they bring and the education and what they've done over the course of their careers, and being able to share that with them and having that direct contact, that direct resource, something that's wonderful and helps us be a little bit better at what we do on a regular basis as well. And then finally, the continuing education. It all kind of comes back to this, but specifically, we do have a few different programs that we do like to go through. So I'll pass it off to Zach. Zach's got a couple things to roll through with the next slide here.
Yeah, thank you, Mike. One of those things that we're always working on behind the scenes is working with our centers of influence. We call them estate planning attorneys, CPAs, real estate brokers, lenders, and insurance experts as well. We really enjoy doing this, not only for us to learn about the things going on in different industries and how we can better work with them, but also so we can vet out certain individuals that if you ever need assistance or you need guidance in a certain one of these categories, that we have people that we can hopefully lean on and trust, and you as well. So we're constantly working on interviewing those people, collaborating with them in a deeper way. Recently, we've met with a few estate planning attorneys that have given great guidance on different scenarios with the Secure Act and when trusts are beneficiaries, and really stressing the importance of especially a young family having an estate plan and purpose in place right away as well. And another one of those is just with the interest rates. Chris is going to go through that in more detail, but on the mortgage side, the spread between the average mortgage rate, which is 3.6 right now, the average mortgage rate that's out there, and the current 30-year fixed around 7% is the widest it's ever been in 40 years. So we love meeting with these people to give us little tidbits and different pieces of advice, and also to assist you better. One thing that Mike mentioned that just wanted to touch on, you've heard Chris and our team say this for quite a long time now, is just we're here to really help you plan, live, and give. And part of that is making sure that we're always staying on top of the latest information out there through Ed Slott, the foremost IRA tax planning expert in the world. Chris has been studying with them for 15 to 20 years, Ken for a similar time frame, and the Academy for Preferred Financial Advisors. We had 2 teammates just with them last week just to go through the impact of different rules with tax legislation that Ken will go through in more detail today, but also the live it side. There's certain things that we do here that we know that if we optimize your taxes, that's great. We're really trying to do that, but we really want you to live a more meaningful and joyful life throughout retirement or whatever phase of life you're in. So some of these coaching groups help with that as well.
Thank you, Zach. I appreciate that. It kind of reminds me as we go through that economics, we talk a lot about this stuff. We do it every single day. And really, economics isn't funny to everyone, just to those who know how it works. So think about that one for a moment. That's always good. So looking today at what's going on with the markets, and I asked chat.gpt, what do clients want to know from their retirement planners at an economic update? Here's what it said. This is direct from AI. Maybe it works for you as well. An economic overview, how the current economic situation, both nationally, globally, and also, is it likely to impact the retirement assets? What major economic changes have occurred since the last one? Let me just hit a couple others. Interest rates, market performance, portfolio review, that's more individual, risk assessment, tax implications, retirement income, policy changes, opportunities, and future projections. Now, I am phenomenal with projections. Phenomenal. As long as my projections or predictions don't have anything to do with the future or people. Otherwise, I'm almost 100% at things that happened in the past that I know. At any rate, the projections I always look at is quite funny. Global events, alternative investments, estate planning implications, and next steps. As I looked at that through chat.gpt, it's almost exactly what we follow. So it's neat to see this. It's neat to see it give us some answers. But using AI in a day-to-day business, it's nice because you can get a lot of information that you don't have to pay as much attention to, so you can concentrate on the human. What I do want to begin with, as I mentioned before, is it's a trying time right now. The markets have not been cooperating well for the last quarter, almost down 10% on the NASDAQ, 5% or so on the S&P. But what these might do for us is they cause your neighbors to walk out and start to give you unqualified advice, your friends, those people who are in the line next to you, people who are selling insurance. Oftentimes now you'll find annuity salesmen to be much more prolific right now than ever before. And I've done this for a very, very long time. When it comes to me, I see this now as a necessary part. I can feel the pain that everybody feels, but I also have a strong knowing that this is what it takes to move up again on a long term. This is what it takes for us to get through. When I talk about faith, patience, and discipline, they may seem like words, but these are when they actually are needed. These are the times that if we're patient enough, we'll get to the next upturn, and it's going to surprise everyone at how big or how short or how small or how long it is, whatever it's going to be, right? It'll happen, but we have to get through times like this and have the discipline not to do anything silly. I just wanted to mention that as we began, because there's an awful lot happening that's going on in the markets. And I think this is a time when you'll see things like wars overseas, interest rates where they are, fighting amongst our own House or, House of Representatives and our Senate. Next year, I want to give you some strong predictive events. Next year, there's going to be an election. I'm going to predict that. And in that election, you're going to find some people who are not happy with the results. And I'll bet you there's a chance on social media that they might say some negative things. That's about as far as I'm going to go with my predictions. The market is definitely going to go up or down. Around 3/4 of the time, it's up. Over the very, very long term, it's up very much higher as a percentage than that. And those are odds we do like to play. So have the faith, patience, and discipline to stick with it. As we talk more about some of the details of the market, I'm going to have Zach flip over to the annual end of the world. Zach, what's going on with the annual end of the world?
It's one of our favorite charts to go through and bring to you as just the constant reminder. We always study different biases that we have at humans, and one of those is a recency bias. So when things happen in the short term, right before we think that is what's going to occur moving forward, or a dangerous saying that we always try to avoid, which is this time is different, right? So this chart is amazing for that, which is since 1980, the average intra-year drawdown marked by the red dots on your screen, if you can see it and are following along. Through the intra-year since 1980, the market has gone down at one point during the year by 14%. But yet the average return during that period of time is 9.8%. So every single year, there's an average drawdown of over 14%, but that's not necessarily where the market ends up for the year. So when we've studied this over time, there's some really dramatic ones where it makes a very big difference. One of those was 2020, where if we made a bad decision when times were tough, we would have missed out on a 50% return, marked by the red dot to the gray bar. So last year was one of the fourth toughest calendar returning year since 1974. So as Chris said, we're in this with you. We know it is a tough time, and it was marked by the returns last year, but a great recovery this year. Pretty much every single market predictor or economist to start the year has been completely wrong so far. So that's why we don't make those type of predictions. And it's the annual end of the world. There's always a different reason. In 2018, it was certain things with North Korea. We had a global pandemic shutdown in 2020. This year, it's war, it's interest rates, it's inflation. So that gives the title and one of our favorite charts to go through.
Perfect. And I want to reiterate that it was something that Zach said. We feel this with you. We aren't immune to feeling these things. We 100% are there with you. We're human. We feel this. What we have is this perspective that we're bringing you right now. So something that he also mentioned when we talk about a drawdown of what 10% or more is on an annual basis, we consider that to be a market correction. And so the components of what creates a market correction, there's lots of different causes out there. We're not going to single out any single specific one because we never really know what could be the next one. There's the ever unforeseen event that always occurs. And so, but in regards to the market corrections themselves, they're swift. They come without warning. We don't know when they're going to end. They're never going to be pleasant. The planning ideas and what could happen because of them is pleasant, but as they're occurring, we're human. We feel this. It's not wrong to feel upset about a correction or when it's occurring, but you need to know that sticking to the plan is the way, the solution, our way through it. They leave scars on those who react poorly, getting out during a correction. We have a wonderful slide that's going to illustrate this a little bit better about what your opportunity cost is when you get out to stop that volatility when markets are down. They're temporary. Historically, they always have been. They've always recovered historically. This is the current one that we're in. So those are all things to think about. And then they're vital to the long-term return. You know, I've heard a great analogy, and it's a surprise it came from somebody on this chat here. But you know, it's always the correction itself is the rain. What comes afterwards is the green lawn, the growth, the creation. The garden grows better after the rain itself. And needless to say, it creates an essential element to the health of a long-term bull market. In this case, the garden that we're speaking of.
Yeah, thank you, Mike. And going through the corrections in a little bit more detail, sometimes a question that is asked to us is just how often do these type of corrections happen, or as certain drawdown, how often does it occur? A 5% or more, and as we showed the end of the world, occurs quite often, every 40 days or so, a month worth of trading days. A 10% or more, you know, every half year or so, or a third of the year. 15% or more is about once per year, like we showed with the annual end of the world. And then 20% or more drawdown, really every five years or so. And what's been really interesting in what we've, you know, gone through is, again, we're not using this to predict the future, only what has occurred, because we've actually had pretty much 20% drawdowns in the last 5 years. 2018, we had a 19.8% drawdown to end the year. 2020, we had one of the quickest 30% drops since the Great Depression, and then last year as well. So that hasn't reflected in returns. Returns have actually been fairly decent during that time frame. But these things happen quite often, and as Mike mentioned, they're necessary and needed for the long-term growth, and present an incredible amount of planning opportunities that we'll talk about a little later as well.
Thank you very much. That was awesome. Hey, Ken, I know you're going to talk about here, but I just had some breaking news I wanted to break in here. I just got some stock news today. I got to report this real quick. It's so bear with me, but it says here's stock news today. Helium was up, feathers were down, paper was stationary, fluorescent tubing was dimmed in light trading, knives were up sharply, pencils lost a few points, hiking equipment was trailing, elevators rose, escalators continued their slow decline, weights were up in heavy trading, mining equipment hit rock bottom, diapers remain unchanged. The market for raisins dried up. Balloon prices were inflated, and toilet paper touched a new bottom.
That's a great update. Now, are those leading indicators or those lagging indicators? I don't know.
A little bit of both, but I think some serious stock news. I just wanted to make sure that if you're paying attention to the market, I just wanted to keep you up to the latest snuff at any rate.
Oh my goodness, that is funny stuff. That is funny stuff. What's also interesting here is as we move on from the wonderful economic joke that Chris just said, is we're in a period of inflation. We're in a period that things cost more. What is this? What is one of the saving graces of how we can invest into that, and what you've done over the last 20, 30, 40, 50 years of investing? What's going to be the next 20, 30, 40, 50 years of investing? How do we keep up with what's going on today? It doesn't feel like we're keeping up just in the moment that we're in right now because of stocks being temporarily down or great companies being temporarily down in cases, right? Because inflation seems a little higher, yet our portfolio isn't rising the way we want it to keep up. The reason why we're in the position we're in is because our purchasing power has kept up because of the wonderful investing that's been done over the years. Take a look at this chart right here. It says, where were we and where are we now? When you take a look at this goes back to the 1972 timeframe, so 50 years ago, so quite a few years of data here. The S&P 500 was at an index of 118. Yes, 118. There's no missing digits there. 118. Today, 4,240 for the index. That's up 35 times from the start of it back in 1972. Earnings make sense, keeping pace with the price of the index, up 35 times. Ladies and gentlemen, this is why we invest in great companies over a long period of time. It keeps up with what we're going to go through next, which is the dividend, also up 20 times, just a dividend alone. Imagine if we never saw a great company appreciate in value whatsoever. The dividend, the cash that gets spun off from that wonderful investment in the wonderful company, up 20 times. Here's the key. CPI, which is the inflation index that's out there, things getting more expensive, up 7 times in the last 50 years. That's why we focus on dividends. That's why we focus on appreciation of great companies. This is why you're in a position today of having the money you have, is because of investing in great companies. This will help us through periods of time that we're going through right now. As we move forward to the next one, this one is a graphical representation of the numbers I just went through, if that makes sense. So what you're taking a look at here is time diversification and the volatility of different asset classes. And we're focusing on 2 major asset classes right now, which are great companies. Some people call them stocks. We call them great companies. The other ones are bonds or fixed income, or the debt of companies. The stocks are in green. The bonds are in blue. The gray is a combination of those two. When you take a look at this, as you on the left-hand side of the chart that you're looking for over a 1-year basis, as we all know, stocks or great companies can be up or down. That's obvious to a lot of people. When you take a look over a 20-year period, a longer period of time, a retirement time frame, this is where it gets interesting, is that the green, the worst case scenario, if all the way to the right-hand side of the column there, the worst case scenario, when you see the 6 there, that means that great companies have earned 6% per year for the last 20 years in the worst case scenario. Your money doubles in the worst 20-year period. Now, we look at bonds, which is the blue, worst case scenario, 1% per year, right, for 20 years. That's only 20%. If we're taking out 4% from our retirement portfolio, our nest egg, if you will, and only earning 1, we're going to be in trouble. If we're earning 6 or so on average, we're going to be in good shape. This is why we own great companies for your retirement now and into retirement as well.
Thank you, Ken. That's outstanding. Thanks for looking at that and giving us perspective on the long term. What we'd like to do is take a look at this. This is called Persist While Others Quit. This is a video, so I'm going to be silent. What I want you to do is watch this very closely. This starts in 1992 at the very left on the bottom. And then you're going to see something here in 2000, right in the top there. That was a peak in the tech bubble, if you will, Y2K. And what happened? The market dropped precipitously. So what happened after that? Let's take a look. Oh, made my money back by 2006. Oh, just in time for there to be a housing bubble. Woo! Temporary drops. Look at the volatility of how quickly that dropped and recovered. And 2012, off to the races. A few little jets in there. Upturn again. What's interesting about this slide is there's 3 bear markets in a 5-year period from 2018 to today. That's not happened if you go back and look at some of the data. And I guess you call maybe 2018 is a 19.9%. So it smelled like a bear, looked like a bear. But that's something you've been lucky enough to experience over the last 5 years. Thank you for your persistence and to persist while others quit. This is a kind of volatility that you don't know is there that will cause those who hang on often to make a lot more than those who exit. So just wanted to offer this to you. And on to the next slide as well. Taking a look at interest rates, I'm going to pass this one over to Mr. Mike Mann. So Mike, can you give us an idea what's going on with interest rates and inflation?
I'd be happy to. So what we know right now is that interest rates have gone up at a historically high rate this past year. And that's just because the Federal Reserve is trying to combat inflation. They're making money more expensive. They're trying to bring things down. Well, what they found more recently is that interest rates have been sticky as inflation has also been sticky. But what we've seen most recently in the last couple of Fed meetings is something called a hawkish pause. And so basically what that means is in one way or the other, by not doing anything, they're being aggressive. They're making an aggressive decision because they are paying attention to what's going on in the economy, everything else that's going around. And they have deemed the United States economy to be strong enough to be able to withstand the current interest rates that we're at. And what we're hearing is that typically people are expecting, and this is what the market is pricing in and what individuals, humans, and you never know 100% what's going to happen, especially when you're working with people. But individually, people are thinking that higher for longer could make a lot of sense. This could be an interest environment that sticks around for a little bit itself. And so we'll see what the Fed continues to do in the future. Some think that they might bring rates down at some point if we do see some sort of economic hardship. Could it get back to the points that it was before? It could. That's unlikely. This is actually a little bit closer to where things have been historically in a healthy economy. So we'll continue to see what's going on with those. Projections they're interesting, but nobody really knows what's going to happen, because if you would have seen last year, nobody had any idea. They tried and tried and tried, and all we heard were revisions every single quarter, every single month itself. So something that I wanted to talk about in the interest rate environment that we're in, though, is bonds. Bonds took it on the chin last year. We watched bonds have the worst return that they have had in pretty much the history of the index itself. And any chart that you take a look at, all of a sudden, there's just one huge downturn in bonds. Now, why did that happen? Well, the reason being is because a bond issued at the beginning of 2022 issued at an interest rate that wasn't as favorable to one that you could buy at the end of 2022. That makes the price of the one with the lower interest rate much lower than that you can buy the one with the higher interest. It's at a discount. And so because of that, that price deflation in bonds itself, that brought the index down, and bonds had a terrible return. So that's the answer to why bonds had such a hard time. Now, I want to circle back to having the portfolio manager who came to visit us, who is one of the managers on one of the bond portfolios that we look at, and some of the interesting things, the perspective that he shares on this. And truly, if we're at a point that the interest is going to be higher for longer, what we're going to see is the return of bonds being much more similar to that of interest, and a little bit more than what you could get in cash. So we'll continue to look at that from a perspective that bonds could be back. And that's really what they mean, really, because the likelihood of them hiking rates the way that they did before, that's fairly low. Could it happen? Absolutely. Would interest rates go from 5% to 10%? I mean, maybe. But at that point right now, we do not see that as being a big of a risk as price deflation. So bonds are a wonderful place as an asset class. The 60-40 portfolio with true bonds is something that we really like for retirees. And we'll continue to like that. Sticking to the plan long-term makes sense. And that in this environment is something that bonds are looking at as like more and more of an attractive investment for that safety net that didn't exist last year. Don't let last year scare you and think that bonds cannot be that safety net, truly. And I want to say it one more time. Do not let last year scare you. That was a unique interest rate increasing environment. It's unlikely to happen again. It could, but it had never happened more than once in the previous 50 years. And that one time was last year. So let's look for bonds to be bonds again. Let's look for them to be a good portion of the portfolio and continue to think about them in a positive light, just like that. Thanks, Chris.
Thank you, Mike. I appreciate it. So one of the things as well, interest rates are interesting. You might not think that there's a whole lot to them. You might not think they tell you a whole lot. But what we've found over time is there's quite a bit of history in them. They kind of play a pivotal role in the global economy. And they're not well understood by most people. So to have somebody like we've talked about come in and talk about interest rates, it's really been beneficial. On the next slide, I want to show you something that most of you can understand as well. If you've looked at what's happened lately, there's been a mortgage rate surge. So the red line on this is showing you mortgage interest rates since about 2013 when they were at about 4. So that's the red line. The blue line on this is going to be existing home sales. So we heard quite a bit about that, and you'll kind of follow along to about 2/3 of the way, and you'll see a massive drop, if you will, in home sales, only to a 2% increase over time, which is less than the replacement rate. But interest rates came down and down and down from 2018, from right around 5 all the way down to just above, just below 3%, sometimes in the high 2s, which was pretty amazing. But since 2022, when they started raising interest rates, look at the massive increase, one of the biggest increases for fast pace of all time. Look at the correlated sales of existing homes. They have fallen dramatically. They've fallen from 6.5 million to around 4 million. So interest rates play a massive issue with demand. If you think about it this way, if somebody's borrowing $100,000 and they're borrowing it at 3%, that's $300 right on that $1,000, or on $100,000, that's $3,000 in interest, if you will. Now, on that same $100,000, when interest rates are near 8, about 7 right now, let's call it 7%. That's $400 or $4,000 more per year, just on the basis of interest rates, not the price of the home. So you're starting to see a lot of home sales slow pretty dramatically, even in some of the hot spots that were in America as well. We just like to show this is the real correlation between these. Now, just as exciting, and we're going to talk about in a little bit, the opposite side of this equation occurs as well. And that is what's going to happen with cash and cash alternatives as we head forward. There's a lot of things going on with the cash and cash alternatives that we'd like to talk about, and some of the things that you can do with those.
Thank you, Chris. We appreciate that. And yes, cash alternatives. There's conversations right now because cash is actually paying something. We haven't seen it for 10 years, 11 years. It's, cash hasn't paid much at all. And so it hasn't been a topic of conversation for a long time. Now it is. Markets are down temporarily. Cash is up temporarily. And this is an interesting time where we can get distracted on what we call the short term, because it's interesting is that when you take a look at cash right now, you could walk into a bank and you can see on the screen here, there's 3 or 4 different ways that you can do this. There's 5 or 6 different ways, really. We have 4 listed here. You could walk into a bank, CD number 3 here, and you could lock your money up for 12 months and get over 5%, which is interesting to some people. Now, there's different ways, there's different options that you have that you need to know about and be aware of them. When you take a look at this high yield savings accounts, sometimes you may have money at the bank, and sometimes banks aren't always forthcoming in information and saying, hey, by the way, we can earn a little bit more if you look at this solution over here. Sometimes they are, sometimes they aren't. If they're not, and we're earning, say 0.5 or 1% on our money right now, there are opportunities for you to do better. There's ways that you can use. Some people have used I bonds in the past. They're not being talked about a lot right now because they're actually paying less than what a CD or our cash alternative can pay at 4.3%. They were at 9%, which was really interesting. And that was the topic of conversation for a long time. Now we don't hear too much about I bonds anymore. Because why? Because they've dropped off. They've dropped off a touch. And so when you look at this, we have a great solution here for our clients that they're utilizing, which has daily access versus locking it up. Access versus not, if you will. That's paying over 5% right now as well. So there's a great solution out there for you. If you have a scenario where you have unused money or cash savings or slush fund, whatever you like to call it, at the bank, and we're not sure we're earning as much as we could be, let us know. We have 3 or 4 different options to look at for you to best utilize and to best optimize what you have there.
And thank you. One of the things that we see as well, and we want to make sure this is well known. I was just at a program recently here on Friday, which is, on Wednesday, if you will, which has a lot of the top business advisors, if you will, and also entrepreneurs in the nation. It's called Strategic Coach. And I found that 4 or 5 of them had sold recently, and asked them, oh, that's interesting. What have you done? A lot of them are sitting in cash. And I tried to remind them, it's a very important point. This is not a forever solution. Remember, money markets and cash will fluctuate with interest rates. If some of the different economists are correct and interest rates tend to fall back towards the hopeful goal of 2 or 3%, also money markets may fall in a correlation with those as well. So it's not a forever solution, nor are CDs. It's actually a temporary solution, only beating right now, barely beating inflation, if that at all. Historically, cash has not been a big position like that. But more and more and more people are stockpiling more and more in cash because they haven't seen rates like this in a very long time. So I just want to remind you, it's not a forever solution. It's a temporary holding pattern. When markets correct, are great times historically to pick up more great companies. So I just wanted to make sure we remind that in a perspective. I've been through this many, many times. And as much as it feels good when the market's a bit fluctuative to put money in cash, it's probably a time when you're uncomfortable to do something else with this, put it to your long-term plan. Anyway, I just wanted to make sure that you knew that. Thanks, Ken, for bringing that up as well. And I think the next one that we have on our slide is, should I be worried about current events impacting my portfolio? And the answer is, if you're planning on taking money out when they occur, possibly. If you're looking at your long-term plan, probably not. There's a lot of things going on we pay attention to. We pay attention to what's going on with the different wars, economic crisis, strikes. Are they still letting things pass through the straits and stretches between Athens and Turkey? There's an incredible path that goes between there and goes between the Middle East that actually comes all the way to here, bringing goods, also across the seas from China. So looking at all those different relations, there's a lot of things economically that happen. And it's why the US is re-onsourcing, bringing things back here for manufacturing. But I would say we always have an eye to the current events, to what are happening. A lot of times, though, I'm going to say this. So I was just fortunate enough to be somewhere near one of those. And just like when I was in 2001, I was in Argentina. Right before we left, they talked about killings and all this stuff going on, protests. And it's a city of 16 million people. We saw where the area was when we toured the city 1 or 2 days later, but about 80% of the people on the airplane that we took to Buenos Aires had canceled because of what they saw in the media and the news. I had people texting me, "Oh my gosh, are you okay? Is everything all right there?" There was zero sign whatsoever of what you saw happening in Gaza or Ukraine anywhere near where we were. It's just amazing. And it really struck home for me again, how much the news sensationalizes what's happening and gives you so many views that you believe it's happening everywhere. This riot, the whole city of, Athens, the whole city of Istanbul is all up in arms about what's happening in, another area. Just not true. We did not see that. There are some areas where people would peacefully protest, but not even while those events were going on. They were still trying to filter those out. So be very careful when you're looking at news about current events. A lot of times what it does is people will have a gut quick reaction to do something incorrect. The market will drop, and it's typically a great time to purchase great companies. So as I look at that, I want to say, be careful with the news driving any sort of investment portfolio news, because the news, remember what the goal of the news is? Everybody remember what that is? To keep your eyeballs watching the news, and most importantly, to sell commercials. That's how they operate. If they tell you, hey, everything's going to be okay, click, and they don't get paid. So remember, the vested interest of the news is to keep you watching. Sensationalization is what they do, and it's got to get worse and worse and worse. So just be careful of falling into that trap. How about in the financial planning world? The next category we're going in is into financial planning. And what I wanted to touch on here, what are the financial planning opportunities? There's a lot that goes on in these kind of times, especially when markets correct. We'll talk about some ideas like Roth conversions and others. But I want to go through the 8 great stakes of retirement planning. We've had these for quite a while, but this is probably perennial. This is something we can see all the time. This one goes beyond, just the events for today. But some of the 8 great mistakes of retirement planning are not having a team assembled. So a team assembled being somebody like a quarterback like ourselves, maybe an accountant, also estate planner. There's a bunch of other centers of influence that you can have as well, depending on your situation. Also, maybe looking at senior planning, and we'll talk more about that a little later in the program. Also, not having an overall plan for retirement period. You'd be surprised at how many people I'll talk to in the public and just have a conversation. Hey, I'm from so-and-so. Oh, great. I know people from there. So, what are you doing? What's your plan for, retirement? Do you have a retirement plan? Most people walking in say, no, I really don't. And you'd be surprised at who that is. From CEOs down to people who've just worked at companies, a lot of people do not have an overall arching plan for retirement. So by being here with us, you do. I just wanted to give you a kudos for that. Not having or not preparing an honest budget. You see the word honest is italicized. Sure, I can get by on is not a budget you want to enter retirement with. I'd rather have you enter retirement with a budget that's above what you probably will spend, so that your projections end up giving you a conservative scenario. 4, projecting returns that are too high. People get to jump on the internet now and put a number in. What do you expect your returns to be? Oh, 10% every single year. Oh, that's great. If we could do that. But when you look at returns are variable, and they're sometimes multivariable. And when you retire, the most important returns that happen are the ones that happen at the beginning. 2 bad years at the beginning can make a really, really rough difference to a plan failing versus when you're accumulating. If we have 2 bad years, it just figures out. But when you start distributing money, everything changes. 5, bad habits. Enough said. 6, not planning for the spouse that does not handle finances. So what I like to do often is when we're talking about something, some big complex plan, that's awesome. I like to turn to the spouse. So what do you do if so-and-so doesn't walk in tomorrow? Usually that spouse will say, I call you or somebody like you. Make sure you've established that or your friends have established that. And not making decisions while we still can. This has been told to me by a lot of different people who are in that senior planning business. While we can make decisions, make sure we're making decisions about our future that we would like. Number 8, probably the biggest one we see to most people that would make them, quote, unhappy or unsatisfied is lack of purpose. This is the most important part of your plan. We've literally seen people, unfortunately, wither away feeling like they do not have a purpose, feeling like they don't have a reason to be here. And from time to time, unfortunately, I've heard that from some of our clients. We want to let you know you do. You are very important. You just sometimes can't and don't recognize it. So number 8 is one of the biggest of the 8 great mistakes, but you do have a massive purpose here. You just may not recognize it at this time. So anyway, I wanted to just run through quick the 8 great mistakes of retirement. These are some things we like to help immunize or maybe work against and help you understand and realize your place and put a plan together for you. But these are some of the pieces that we found over time have been very, very important. Now, some of the planning items that we also have here, and the next one, tax planning, rebalancing, charitable giving, Roth conversion, Social Security planning, income planning, and healthcare planning. We'll always have these listed. We may not go through something in every single category, but we wanted to bring a few of these up because I know Ken would like to talk a bit about tax planning. Zach has some great stuff on rebalancing, and Mike has some awesome stuff when it comes to Social Security planning as well. So why don't we hit a couple of these items as well?
Appreciate it, Chris. Thank you very much. Let's talk taxes. Just for briefly here, just for a minute. Taxes are something where, again, it's something we'd like to see from you. So when you come in for a planning review, if you will, we would love to see a copy of your taxes. It tells us quite a bit about what you're doing. Most likely we've seen them before, but if we haven't seen one recently, we'd like to see one because there's ways where we can help you optimize and put more money into your pocket. It doesn't show up on your statement as a rate of return, but it shows up in your pocket in your overall plan. Something we really want to focus on with you. When it comes to taxes, there's a topic out there that's making the news, if you will. It's making some headlines right now because it's coming to an end, and it's the tax program that we know that we have now, basically. Okay, and so it's sunsetting at the end of 2025. So we have 23 taxes, 24 taxes, and 25 tax. We have 3 more years of what we know now, which is the higher standard deduction and lower tax brackets, if you will, as far as percentages goes that we're paying in taxes. Those are really the highlights of what we have now. But that's sunsetting at the end of 2025. If there are no changes between now and then, it reverts back to what we had before, which some of you remember of the larger itemization that we had there. We had AMT also during that time frame, the alternative minimum tax. We also had different percentages for different brackets. The 12% used to be the 15, so on and so forth. So there's changes that are going to happen if nothing happens, if that makes sense. So we'll see in the coming years if there's new legislation that comes out, tax revamping, maybe a tax continuation, we shall see. But we have a keen eye on this because when it comes to family wealth distribution that we talk about, this has a big play on this, is like where we are today for taxes for the family. Where are we down the road for taxes? So we want to talk about taxes today. We also want to focus on what taxes could look like in the future as well for you.
Thank you, Ken. I appreciate that. That's outstanding. Next thing, Zach, why don't you bring us a little bit on rebalancing? Just a reminder, it's a great time when things like this occur because we've got different assets moving at different times. Why don't you just give us a little bit of a re-education? I know many of you know this, but on rebalancing and its effects.
Yeah, thank you, Chris. As you know, and as our clients know, if they've been on the bi-weekly webinars or our forums before, Mike, man, and I absolutely love rebalancing and impacts that it has on it from our personal studies we've done, but also from what we've heard from our partners as well. But really, we've had some, over the last 30 years of building this, Nobel Prize winning theories go into building a starting point of a portfolio by utilizing different asset classes. Mike has gone through amazing amount of stress testing with those different asset classes, but essentially a portfolio starts with a combination of all of them. And then we've found an annual discipline of rebalancing back to those original percentages from when we started out. is first and foremost to reduce risk. Because if some of those asset classes run out really, really far for a period of time, what may occur during those is a massive correction in that asset class, which makes your portfolio more risky, right? Especially when in retirement, when you're drawing income from off of it, we want to keep it as stable as possible. But also rebalancing, since we're selling high and buying low, can actually increase return as well. When we have, you know, an uptrend market of 10 or so years, like from 2010 to 2018 or 2019, it doesn't feel as good rebalancing because you might be trimming off of an asset class that's doing really well. One of those was large cap growth, which you can see on the jelly bean chart here. That's Facebook, Amazon, Netflix, Google, Microsoft, and others did well for a long period of time. However, if we did not rebalance last year, that asset class was actually the most susceptible to a downturn, and in some cases down 40% or more. So we absolutely love rebalancing. The chart, that if you can see it on your screen right now, just shows that every single year a different asset class is either the worst performer or the best performer, and a steadier road is the white box, which is a diversified asset class that's rebalancing, that owns elements of all of them. So we absolutely love rebalancing, and a timeless piece that we utilize here. One of those other planning items that we'll take a look at is just charitable giving. Towards the end of the year, especially, it becomes a very common thing to discuss and look at as we go through different other planning items that we'll talk in a minute, like Roth conversions and others. But really, there's some that come across more often than others, which are qualified charitable donations, where you can actually give directly from your IRA to charity if you're over 70 and a half. So used to line up directly with your required minimum distribution. Since 2020, they've changed that twice now. So your required minimum distribution is now 73 if you're not already taking it, but you can start doing qualified charitable distributions at 70 and a half. Once you're taking required distributions, that actually reduces your required distribution as well. So we'll see the impact and law changes when, as Ken mentioned, the sunsetting, if they get rid of the double standard deduction, which is why QCDs have become more common. We'll see what it looks like then. Something that's become more common over the last few years is donor advised fund. It's essentially bunching multiple years worth of contributions into one and then dispersing it over time as well. So there's amazing uses for donor advised funds for giving to charity. And we've even looked at strategies for people that may want to give their pre-tax assets to a charity of some kind, is actually naming a donor advised fund as a beneficiary. So there's some really amazing things to use with those. As always, there's a stock or appreciated assets or securities gifting as well. That one's always an item to take a look at, especially if you may have bought stock a long time ago. The key is to look for things with a long-term gain to get the full benefit of those. And then, as always, there's cash giving as well. With giving to charity of any kind, the most important part is the act of giving, but if we can do it smart and save a few dollars on taxes, we're always interested in it as well.
Thank you very much. I appreciate that. Let's turn over to Mike and look at some ideas with Roth conversions. Before we do, Zach, thank you about the giving. The second thing about giving that probably supports America most is that it's not always just about stock or money. It's about giving maybe time, energy, attention. Resources such as money are great, but a lot of these great charities need people who volunteer. Zach knows that. He does a great job. You know, and some of those are the most important things you can do, is just being there with them, for them, giving them ideas, being their legs on the ground, because a charity doesn't exist unless there's somebody there doing something for it or for someone. So I just wanted to say, it's not always just the tangible, but it's also the intangible. So those are great. We don't want to just focus on those being the only things, because a lot of you are doing great things and you don't have to donate money. You donate something more valuable, your time, experience, or your connections. So those are fantastic as well. I know there's quite a bit that we do with those. Mike, what do you say? What should be going on with Roth conversions? Give me a quick update on what we should be looking at with those.
Thanks, Chris. So the basis of why we do Roth conversions is because we want to look at what we can do now to save you tax dollars in the future. And typically what we can do is spend less tax dollars now to save on what would have been spent in the future. And that's the basis behind a Roth conversion. That's taking money that's in a traditional IRA, moving it over to Roth, paying taxes in that moment of time, to letting it continue to appreciate. And so some of the ideas around this is by the time that you approach your RMD age, then that's a moment that you have this taxable event that's completely unavoidable. So if you have a lot of money in a regular 401k or an IRA, it could be a really good thing for you to do some Roth conversions along the way so that you can lower the amount that you have to take from that traditional IRA when the time comes. And being that that amount could put you in a tax bracket that's undesirable, it just gives you more control. And some of the best times to do Roth conversions truly that we've seen historically are times when the market's low. So when we like to think about this, think about the market as being a spring. And when it's depreciated temporarily, it compresses, right? Let's pay tax now when this value is lower, move it over into the other account. As the market continues to climb and comes back, that amount expands. And that's all tax-free in the future if it's in a Roth IRA, if it's a qualified distribution. So that's all stuff that we want to look at and why we consider these sometimes when some things just, it's a planning item and a correction. It seems like a difficult time to be an investor, but truly it's one of the most fruitful because of the things that you can actually do behind the scenes and save yourself money that just comes directly out of your pocket. We always want to convert with a long-term time horizon. So say that, you may have had a traditional IRA or a 401k, you're a young saver still, you are still in the accumulation phase. And this is before you really knew that you could use your Roth 401k if that was even an option for you. Well, you can convert when you're younger and pay that money while you're working on the taxes themselves. We think about tax bracket management. That's incredibly important through all of this. But regardless of that fact, to be able to give yourself a long-term time horizon of growth, that money's just going to be more valuable to you in a Roth account with a traditional IRA. So those are all things that we're thinking about with Roth conversions. It's all things that's situational. We look at, we have conversations about them. If you guys have any questions about it, please feel free to reach out at any time.
Mike, thank you. That's awesome how you've gone through that. It's actually counterintuitive. So when you look at this, people tend to, do they run out of stores when things are on sale? No, they run into stores when things are on sale, especially around Black Friday, right? So when things are on big sales in the market, people tend to think, oh, I got to flee. Well, actually, no, it's time to probably buy. When you're looking at things are rising, that might be the time to sell. But that's exactly what the discipline of rebalancing does for us. It sells things that are high and purchases things that are low. But conversion is something we get a chance to do. So thank you so much, Mike. I really appreciate that. A couple of things on Social Security planning for the next item that we have. Social Security planning, I think, Ken, what did that go up? Ken, was it at 3.2%? What was the number it came in just recently at?
3.2, Chris, you bet, 3.2.
0.2%. And what do you think? Can you go through all the numbers? I'm just messing with you. So you go through the direct reason as to why. I know there's a lot of retirees on this call thinking, you got to be kidding me. Inflation was only 3.2%. I know it feels like a ton more than that this last year, but that's what their calculations, what they calculated with. So Social Security has a lot of ramifications, especially if you aren't retired yet, or you're retired between 62 and your full retirement age. There's earnings limits. We can talk more about those specifically for you as well. But there's also a few things called IRMA, which income essentially that you're going to take a look at for Medicare and Medigap insurance. So Social Security, Medicare have some very specific rules when it comes to total income that may charge you higher premiums on certain items. It may reduce your total Social Security payout if it's between or before your full retirement age. But those are all things we take into consideration when we're doing your plan and talking about planning. But if any questions come up on those, feel free to let us know. But we did want to let you know 3.2% is the increase in Social Security this year. With that, I think Zach has some planning items he wants to share with us as well when it comes to income planning.
Thank you, Chris. Just wanted to touch on income planning a little bit. A lot of the things that we've talked about has a direct impact on income, either reducing it or even potentially adding to it on purpose through a Roth conversion like Mike mentioned. Really what we love to look at with planning is to have some pre-tax dollars. If you're contributing to a pre-tax 401k for a long period of time, a Roth or tax-free or post-tax as well. That allows us to take from different buckets at different times to control income. That may or may not be an option for a specific scenario, but we're always looking at strategic ways to either reduce taxes now or reduce taxes in the future. And potentially something we've looked at and talked about before is family tax bracket management as well. Is that looking at potentially if there's a legacy involved or kids involved, where are they at? What are their tax rates at? How can we prepare for anything now to potentially help them out, or just so a significant amount of your dollars don't end up going to the federal government that you're hoping to go to them. So income planning is a major portion of what we do in all of this ties in together along with healthcare planning, which Ken will touch on here too.
Yeah, thank you, Zach. Appreciate that very much. Yeah, income planning can come into play when we're talking about healthcare planning, especially if we are before the age of 65. Healthcare planning is a huge, huge piece of why some people retire and when they don't, that we found out over a long period of time of doing this. It's one of the factors that's out there. So healthcare planning, we have wonderful partners. We have wonderful areas that we can help you out in this one. If we're before the age of 65, we're going to need, if we retire before the age of 65, we're going to need to look at some health insurance. What are the options? You have employer, you have Cobra, you have the open marketplace. Like Zach was talking about, income plays into a factor on this one, whether we get subsidies or not. That whole thing is there. Post 65, 65 and older, that's Medicare, of course. There's different plans out there like Advantage plans. There's different drug plans you can take a look at. There's supplements. Which one makes the most sense for you? We have wonderful partners that can help you evaluate and actually make sense of Medicare. Medicare is very, very complicated. There's so many pieces to it. Are we in network? This doctor, that doctor, what's covered, what's not covered, what's preventative, what's a copay, what's part of the deductible. There's so much that goes into Medicare planning, and we have wonderful partners that can help you out if you have questions on that piece. The HSA, health savings account, comes into play when we're talking about healthcare planning. So if we're developing a plan with you and working on that together, and you have an HSA, a health savings account available to you while you're still working, we're going to be an advocate for you and really take a look at that to say, does that make sense for your plan? And most times it does, because health savings accounts really are a wonderful vehicle to help you pay for some of the healthcare costs that are coming up for you in the future. If you have an HRA, a health reimbursement account, those have specific rules in what you're eligible for when it comes to the open marketplace type of health insurance that is out there. So if you have an HRA, we'll identify that and we'll help you through those decisions, because those are pretty unique and pretty specific to overall healthcare planning.
Awesome. Thank you, Ken. I appreciate that as well. And a couple of things I want to say for those who are going to be at the program live. We're going to be talking about cyber threats and technology, really about malware and all sorts of other things as well. Let me give you a little bit of an idea. This, we've talked about it before. There's some certain items that we could bring up and show you in different slides, but let me tell you a few things. Be aware of phishing scams. There are fraudulent attempts to get bank account numbers, confirm different things. You've seen them before, but be very aware of them. They're getting more sophisticated in how they're doing those. Tech support scams, Microsoft calling you, Apple calling you, saying, hey, we need your passwords. We need to just hop on your computer to fix something. They don't call out for those things. Romance scams. A few of you have understood those and had relatives or people who've been involved in romance scams. After somebody passes away, there's a very, very lonely 5 or 6 months that they actually know exactly when to prey on and how to do it. I'm exactly like your ex. Oh, and they under the guise, and sometimes even under the guise of religion. So be very careful on those as well. You may meet on a legitimate place. Hey, let's get off there. Let's talk about this. So be very careful. Grandparent scams is another one. They call an older person, pretend to be a grandchild in distress and asking for money to help out. Medicare healthcare scams. Lottery sweepstakes scams. I just got apparently just the other day, and this is cool because I'm going to follow up right after this. I have a insurance policy with somebody, a Doty, Doughty, who passed away just recently, but had no other heirs. So I've got an $11 million life insurance policy I'm going to cash in just after this. I'll make the call in just a bit. No, I don't. But again, these are the kind of awful lot going on with that. Lastly, today, I just want to touch base on you on a topic that's been going on with a lot of our clients over time. And it's not just our clients for you, it's our clients for their parents. It's for our clients' children who haven't moved out yet. Just kidding, it's not really about that. But the question is, where will you live? I think what they said, you know what the toughest thing about being a cryptocurrency trader is? Living at home with your parents. So at any rate, it's one of the toughest things you'll find about being a cryptocurrency trader. Kind of a joke, but also fairly true. But a couple of things we take a look at. This where will you live is designed to be helpful to you about where I might want to live and those decisions that I or my parents or maybe even children will want to know, things that I can make decisions about today while I still have the ability to do it. So here's some of the different ideas, and we're going to talk about this. We've got a whole program coming up. We had a previous, probably 3 weeks ago program that asked the questions about things you may want to know. And some of the things that came up is, what about healthcare facilities? If it's healthcare, how close and accessible are they for medical facilities? What's the quality of local hospitals, clinics, and specialists? Safety and security. Is a neighborhood safe with low crime? It may be really cheap because it's right in the middle of a horrible neighborhood, right? Are there homes in the area for mobility and accessibility that are designed with features like ramps, grab bars, and no-step entries? Cost of living. Can they comfortably afford the area or on a fixed or limited income? What are all the costs that goes with it? Can I get there? About transportation? How about social engagement and recreation? Senior services. Do they have meal delivery or meals in site or in-home care? Or do they offer them on site for me to go to? Climate and geography, do they prefer warmer, cooler climates? Family, so there's a list of about 10 or 12 different things that are super important about housing option, local amenities. Do I want a senior facility? Do I want a continuing care facility? Can I afford them? Can I not afford them? So in life, there's little D's. Little D's are what am I going to eat tonight for dinner? And then forget that I ate tomorrow. I'm having Chinese food. That's a little D for a little decision. Big D's, big decisions. Where will I spend most of my time? 16 hours a day, sometimes 24 hours a day. We view this as a big decision. So we put together this matrix of about 10 or 12 or 14 different items that you can take a look at to evaluate. I'd like to live somewhere where I've got community. Now, let me give you a story as to why this is important. I'll use my grandfather. About October 9 years